United States government just called an emergency meeting on critical minerals. They scheduled it for this Wednesday, just a few days after silver suffered a 41% crash, the worst in 46 years. Now, ask yourself something. Why would the most powerful government on earth fly in international delegations to talk about minerals the exact same week those minerals got destroyed? What do they know that you don't? And here's the part that really got to me. While you were watching silver collapse from $121 down to $72, while every headline screamed that precious metals were finished, someone on the other side of the world was buying that exact same silver at a 29% premium. They weren't panic selling. They were paying more, and they were doing it calmly, deliberately. While the Western market was in complete freefall, by the end of this video, you are going to see a timeline that will change how you understand this entire crash. You are going to find out exactly who was buying while everyone else was running for the exits. And you are going to see three things that the mainstream financial media has completely ignored, things that tell a very different story from what you've been hearing. I need to set the stage quickly because what happened before the crash matters. But I am going to keep this tight because I know you're right here for the real story. Silver went from $30 in early 2025 to $121 by late January 2026. That is 300% in 13 months. On Thursday, January 30th, two things happened at the same time. President Trump nominated Kevin Warsh as the next Fed chair. Warsh is a hawk, higher rates, tighter policy. Precious metals hate that. The dollar started strengthening. That combination was the pin that popped the balloon. Now, what happened next? I want you to picture this. Friday, January 30th, silver plunged 37% from $121 toward $75. The biggest single-day crash since 1980. 46 years. Traders called it a capitulation event. The word on every desk around the world was one word: bloodbath. But here's the thing. Friday wasn't the bottom. And what happened over the weekend made everything worse. Because someone decided to pour gasoline on a fire that was already burning. Over the weekend, the CME Group raised margin requirements on silver from 11% to 15%. Now, if you don't trade futures, let me explain what that means with a simple example. Imagine you bought a house with a small down payment. Saturday night, your bank calls and says, "We need double the deposit by Monday morning or we take the house." You scramble. You can't find the money. They foreclose. Now imagine that happening to thousands of traders at the same time. Forced liquidation, prices falling further, which triggers more margin calls, which triggers more forced selling, a death spiral that feeds itself. Monday, silver dropped another 4%, hitting $72. Total damage from $121 to $72. 41% loss in less than 72 hours. Gold bottomed around $4,400, down 21%. Its worst crash in over a decade. Everything was red. Equities, crypto, commodities, everything. Now, I need to pause here because this is where every other video about the silver crash ends. They tell you it crashed, they tell you why, they tell you to be careful, and they move on. But not this video, because I am about to show you three things that completely change the narrative, three things that nobody else is putting together. And the first one, when I found it, genuinely made my stomach drop. I had to check the data 3 times because I didn't believe it. While silver was crashing, while every Western exchange was in full panic mode, while every headline screamed meltdown, I pulled up the Shanghai data. The Shanghai Gold Exchange spot price vs. the West. Let me make sure that landed. At the exact same time, Western silver was trading at $78.88. Shanghai silver was trading significantly higher. There was a $20.98 gap per ounce of 29.14% premium. Same metal, same silver, same chemical composition, same periodic table element, to completely different prices on two sides of the Pacific, and the side that everyone assumed was panicking the most. China was paying 29% more for it. Why? Why would anyone pay 29% more for something they could theoretically buy cheaper, unless the cheaper price isn't real? Unless the paper price is lying and the physical price is telling the truth? Unless the Western market is pricing paper contracts and Shanghai is pricing actual metal? Think about that for a second. But stay with me, because the numbers get even crazier. And what I am about to show you might be the most important chart in all of commodities right now. I went back and looked at the Shanghai premium chart over the past 12 months. Not the price of silver, the premium. Just the gap between what Shanghai pays and what the West pays. That gap has grown by 1,874% in 1 year. I'm going to say that number one more time because I need it to land. 1,874%. That is not a normal market. That is a market screaming that something is fundamentally broken. Now, here's the second thing nobody is showing you, and this one is just as wild. On the Shanghai Futures Exchange, every single silver contract hit limit down. AG to 602 minus 20%. AG to 603 minus 20%. AG to 604 minus 20%. All the way down the curve. Every contract locked, frozen, circuit breakers. Triggered. You couldn't trade even if you wanted to. But here is the part that should make you stop scrolling. Convert those limit down prices to dollars. The SHFE February contract at its absolute limit down was equivalent to $94.97. Western futures were at $78.88. China's crash price, their absolute worst case scenario floor, was still $16 higher than where the West was freely trading. Their floor is our ceiling. Read that again if you need to. And China wasn't just watching this passively, they intervened hard. 5 commodity funds suspended from trading, not limited, fully suspended. The UBSSDIC Silver Futures Fund was shut down for the second time in 12 days. 16 traders barred from opening positions or withdrawing money for an entire month. Position limits slashed. They threw everything they had at cooling this market. And yet, remember what I told you at the start of this video? After all of that, silver bounced from $70 to $85. The floor held. Keep that in mind because it is going to matter a lot in a few minutes. Now, here's the question that kept me up last night. The Shanghai Exchange had already started tightening rules on January 27th. 3 days before the crash, they widened price limits, raised margins, reduced positions. They were preparing. If they saw this coming, who else saw it coming? And that brings me to the third thing. This is the one I saved for right now because I needed you to see everything else first. JPM, the biggest bank in America, one of the most powerful precious metals traders on earth, recently moved their gold trading desk to Singapore. Not a bigger office in Manhattan, not London, Singapore, right in the heart of Asia, right where physical demand is surging, right where central banks are hoarding, right where the premiums are 29% above Western prices. Now think about this for a second. You do not move an entire trading operation across the world on a hunch. You do not relocate your people, your technology, your entire operational backbone to the other side of the planet because of one quarterly report. That is a multi-year, multi-million-dollar strategic repositioning. You do it because your smartest people have looked at every piece of data and concluded that the center of gravity for precious metals has permanently shifted east. JPM looked at Asian physical demand. They looked at 14 months of Chinese central bank gold buying. They looked at COMEX disruptions. They looked at Singapore becoming the new hub for gold trading and tokenized assets. And they made a decision, be where the market is going, not where it has been. It's like watching a billionaire quietly sell his Manhattan penthouse and buy farmland. You don't ignore that. You don't shrug it off. You ask, what does he know? Now let me connect all of these dots, because individually, each of these facts is interesting. The Shanghai premium, the limit down data, the fund suspensions, JPM's move, but together, they tell a story that changes everything. This is the part that ties it all together. Remember at the beginning I mentioned an emergency meeting. Here is where that comes in. And honestly, this might be the most unsettling part of the entire story. On Wednesday, February 4th, 2026, Secretary of State Marco Rubio is hosting the inaugural Critical Minerals Ministerial at the Department of State in Washington, D.C. International delegations from around the world are flying in. The official statement says they are gathering to advance collective efforts to strengthen and diversify critical mineral supply chains. Now, if you speak government, you know what strengthen and diversify really means. It means we have a problem. It means we are dependent on supply chains we do not control. It means we need to fix this before it becomes a national security crisis. And here's why silver matters in this context more than any other mineral on that list. And this is a number that blew my mind when I first saw it. Silver is not what most people think it is. It is not just jewelry or coins or something your grandmother keeps in a drawer. Silver is the backbone of the modern technology economy. Solar panels cannot be made without it. Electric vehicles use it in every electrical contact. 5G towers need it. Semiconductors need it. Advanced military systems, from guided missiles to satellite communications, depend on it. Medical imaging equipment uses it. Your smartphone has silver in it right now. Now here is the Number that should scare every policymaker in that room on Wednesday. The world consumed 680 million ounces of silver for industrial use in 2025. That is 60% of all silver demand going into things that get used up gone, not sitting in a vault consumed. And the world has been running a supply deficit in silver for years, using more than it mines every single year. The only thing filling that gap is drawing down existing stockpiles, and those stockpiles are running out. You cannot fix this quickly because most silver is not mined on its own. It comes as a byproduct of mining copper and zinc. There are very few primary silver mines on Earth. Opening a new one takes a decade, so even if silver went to $500 tomorrow, new supply would not arrive until the mid-2030s. That is the structural trap that makes silver different from almost every other commodity on Earth. So think about what could come out of Wednesday's meeting. Government stockpiling programs, where the U.S. starts buying and storing physical silver the way they store oil, in the Strategic Petroleum Reserve, export controls, similar to what China has already done with rare earths, bilateral agreements with allied nations, to lock up supply, tax incentives for domestic mining, restrictions on foreign acquisition of silver reserves. These are not theoretical ideas. These are exactly the types of moves governments make when they realize a commodity is too strategically important to leave to traders and speculators. China already made their move years ago, and this is what most Western investors do not understand. They have export controls on critical minerals, 14 consecutive months of central bank gold buying, strategic reserves being built across multiple commodities. They restricted rare earth exports. They limited gallium and germanium shipments. They are methodically, systematically locking down the physical resources that the modern economy runs on. They are playing a 50-year game while Western financial markets are playing a 50-minute game. China is securing actual atoms, actual metal, actual physical supply, while the West trades paper promises for those same resources. And now, it appears the United States is finally waking up to this reality this Wednesday. I want to know what you think about that. Drop it in the comments right now. Are we seeing the beginning of a resource war? Or am I reading too much into this? Here is the timeline one more time, and I want you to feel each entry, not just read it, feel it. Now, before I tell you what I think this all means, let me bring in a perspective that adds a critical layer to everything we have discussed. And pay close attention here, because this reframes the entire crash. Ray Dalio, one of the most successful and respected investors alive, the founder of the largest hedge fund in the world. Dalio recently said, "Something needs to prick the bubble to cause a market crash, and at first, you might think the silver crash is that prick." But then Dalio said something that stopped me cold. He said, historically, what ended overvalued markets was something that led to sustained outflows of cash. Rate hikes, quantitative tightening, month after month of cash being pulled out of the system. That is what kills bull markets. Not one event, not one crash. A sustained mechanism that drains liquidity. And right now, rates are still more likely to go down than up. Even with wars coming in, the Fed is still on track to end quantitative tightening. The market is adjusting for a slightly less dovish Fed, but Dalio's exact words were, "The pricking we need to trigger a crash is still not here." Think about what that means. Imagine you're driving at 100 miles an hour. Someone taps the brake. You slow to 95. That is what the Warsh appointment was, a tap on the brake. Silver reacted like the car flew off a cliff. That massive gap between the size of the trigger and the size of the reaction tells you everything you need to know. It wasn't the foundations that cracked. It was the speculators, the leverage, the froth, the weak hands. They got destroyed violently, but the road itself, the fundamental case for precious metals, did not change. Not even a little. Remember the 1970s? This is the parallel that everyone needs to understand right now. Gold surged from $40 to $200. Everyone was euphoric. You could not go to a dinner party without someone talking about gold. Then it crashed 50%. Headlines wrote obituaries for the bull market. Analysts went on television and said it was over, done, finished. Regular investors who had put their savings into gold panicked and sold at the bottom. They took the loss. They moved on. They forgot about gold. And then gold went to $800. $800. From $200 to $800. The people who sold during the shakeout missed a 400% move, one of the single greatest wealth creation events in modern financial history. The crash did not end the bull market. It ended the tourists, the speculators, the weak hands. The structural trend continued without them. The people who understood why gold was going up in the first place. The ones who were not just chasing momentum they held. And they were rewarded beyond what anyone thought was possible. Now look at silver. It went from $30 to $121, crashed 41% to $72, and now it is sitting at $85. Gold went from $5,595 to $4,400. Now it is above $4,800. Both metals bounced. Both found a floor. That is not what dying assets do. Let me be very specific about why the recovery matters. Silver bounced from $70 to $85. That is 18% from the lows in 2 days. Now let me explain why the recovery happened. Because it was not random and it was not a dead cat bounce. There is a reason silver found a floor at $72 and not at $50 or $40 or $0. Solar manufacturers cannot stop buying silver. It is not optional. Without silver paste, the production line goes dark, and silver paste is only 3% to 5% of a solar panel's total cost. Even if silver hit $150, the impact on the final product is negligible. But without silver, no panel, no product, no revenue. That demand is inelastic. It does not care about margin calls or algorithms or panic selling. It buys silver because the alternative is shutting down the factory, and it is not just solar. Companies are reportedly locking up physical supply through direct deals with mines, bypassing exchanges entirely when corporations start going directly to the source instead of buying on the open market. They are telling you something about supply that no futures chart can capture. They are telling you they do not trust the exchange to deliver. That is why the floor held. That is where the $70 buyers came from. Now, I always give you the full picture because you deserve both sides, and this is important. There are real risks. This was a speculative mania. Prices went too far, too fast. A correction was inevitable and, in many ways, healthy. Marko Kolanovic, who was JP Morgan's chief strategist, has warned silver could fall to $50 as the froth unwinds. That is a real scenario. A stronger dollar could keep pressuring metals for weeks or months if global growth slows. Industrial demand softens. These are legitimate risks. Anyone telling you silver only goes up from here is either lying or selling something. This is not financial advice. Do your own research. Talk to a professional. Never put in more than you can afford to lose. Now, before I give you my personal take on all of this, I want you to sit with for questions because I have been trying to answer them from the bearish side for days, and I cannot do it. If this was just a bubble popping, why is Shanghai still paying 29% more for physical silver? If demand collapsed, why did China suspend funds to prevent excessive buying, not excessive selling? If silver does not matter, why did the biggest bank in America move its precious metals desk to Asia? And if none of this is important, why is the United States government hosting an emergency critical minerals meeting this Wednesday? Nobody in the mainstream has answered a single one of them, so let me try. Here is my personal take, not as a financial advisor because I am not one, but as someone who has been staring at these charts, reading these filings, and losing sleep over this data for days. I think we just witnessed something historic, and I do not mean the crash. Crashes happen. They are painful, but they are normal. What is not normal is what this crash revealed underneath. I think Friday, January 30th, was the day the paper silver market and the physical silver market officially divorced. They used to be married. They used to move in the same direction, roughly at the same speed, with small differences here and there. That marriage is over. What we saw this week is two completely separate markets pretending to be one. The Western paper market, driven by leverage and algorithms and margin calls, crashed 41%. The physical market, the actual metal that factories need and governments are stockpiling, barely flinched. Shanghai kept paying over $100 equivalent while New York was selling at $72. That is not a normal divergence. That is a separation, and I do not think they are coming back together anytime soon. And here is what really bothers me on a personal level. Wealth does not disappear in a crash. It does not evaporate. It transfers. It moves from one set of hands to another. From people who react to headlines to people who read data. From people who panic at red screens to people who have spent months preparing for exactly this moment. Rewind to Friday morning. Your screen is red. Every number is negative. Your gut is screaming, sell everything. And at that exact moment, someone in Shanghai was paying massive premiums for the same silver you were about to dump at $78. They looked at a 41% crash and said, I will take it. That was not a retail investor. That was sovereign money, strategic money, the kind of money that thinks in decades, not days. That is a wealth transfer, and it happens every single time. Every crash, every panic. That is why I make these videos, not to tell you what to buy or sell. I genuinely do not care about that. I make these videos because I believe the biggest disadvantage regular investors have is not money, it's not access, it is context. The ability to zoom out when everything is screaming at you to zoom in. The Shanghai premium, the SHFE floor price, the JP Morgan relocation. The government meeting, none of that was on your screen on Friday. But all of it matters more than the red candle that was. So when people ask me, is silver dead? I think they are asking the wrong question. The right question is, which silver? The paper silver that trades on your app. Maybe that market is broken. They just proved it. But the physical silver that China is hoarding, that JP Morgan moved to be closer to, that governments are holding emergency meetings about, that solar panels and missiles and semiconductors physically cannot exist without, that silver has never been more alive. And the fact that those two silvers now have completely different prices is the single most important development in commodities in my lifetime. That is my honest take. I could be completely wrong, but I have looked at the data from every angle I know how to, and I keep arriving at the same conclusion. That is the answer to the question I asked at the very beginning. Who was buying at $72 while everyone else was panicking? Now you know, and now you know why the crash was real. The pain was real, but 1,874% of premium growth over 12 months tells you which direction this story is heading. And what happens in that meeting room in Washington on Wednesday might just determine how fast we get there. Drop your take in the comments. Is this the end of silver, or the setup for something much bigger? I read every comment, and the sharpest analysis on this channel comes from you. If this connected dots you hadn't seen before, send it to one person who needs to see this. And if you are not subscribed, fix that. This is Iron Bull Finance. I will see you in the next video. The metals market is undergoing a deep landscape reshaping. This is a fundamental struggle over the ownership of pricing power and control over physical resources. The original boundaries of the market are being shattered, and a brand new valuation system, centered on physical atoms, is accelerating its formation to help everyone survey this unfolding structural evolution more systematically. We have compiled a silver battlefield victory map. It provides us with a deeper perspective for reference. I have placed this guide in the comments section. Click to claim it.